Hello, I'm Hansley from Livewire Markets and welcome to The Pitch. Joining me today is Teiki Benveniste, the head of Ares Wealth Management Solutions in Australia. Teiki, chances are people might know what a CDO is, especially if they lived through the global financial crisis. If you're too young to know what that is, watch The Big Short. But what in plain English is the subject we're going to talk about today? Collateralized loan obligations, or CLOs.
Yes, so quite different experiences if you've invested in a CLO or a CDO during the GFC, that's for sure. So just to explain what a CLO is, collateralized loan obligation, it's effectively a pool of diversified senior secured corporate loans. So you talk about 200 to 300 loans across multiple issuers, multiple industries. So it's not all in real estate, for instance. It's going to be quite diversified, and it's actively managed by investment managers such as ourselves. And then what you can do as an investor is you can invest into debt tranches that are issued against those pool of loans, and you can decide which level of risk you want. The lowest level of risk, highest quality, is going to be AAA. Independently rated by a rating agency, all the way down to single B. And if you look at history in terms of those debt tranches and the levels of defaults that they've experienced, especially in the investment grade side of things, and you compare it to CDOs, well, the levels of defaults you've experienced in CLOs has been quite minor. It's been almost zero. I think the worst it has been through the GFC was 0.3% over 12 months. If you look at CDOs, over the same time period, the worst time or 12 months rolling default rate was about 30% in investment grade CDOs. So very, very different experience.
Okay, so it's interesting you bring that up because I guess CDOs were often criticized throughout that 2008-2009 period. They were so opaque and they were difficult to understand. So with that then, are CLOs any easier or more transparent to examine?
They're absolutely more transparent, and we use a proprietary technology to be able to look through to the underlying loans in real time. So every time we make an investment into the debt tranche of a CLO, we're able to actually break it down to the underlying components and apply our own credit underwriting. We're a very large manager in the syndicated loan market, in the loan market, so we have capabilities there to actually look at those loans and think, okay, what is the actual risk in that pool of loans? Is that BBB tranche really a BBB tranche, or is there more risk in this one versus that other one? And so when we do that work with that level of transparency, two BBB tranches of two CLOs trading at the same level because they're managed by a great manager and the returns look the same, well, we're able to say, well, actually, we'll buy this one because we feel the credit quality of the underlying loans is better there than in this other one.
All right. So, listen, the question needs to be asked as well. Obviously, given CLOs are investors in leveraged loans and we've seen this historic rate hiking cycle, some people would say it's still not done yet. But are you and the team at Ares concerned about a big spike in defaults?
I think we're paid to be concerned, so we're always concerned. No, but in all honesty, I mean, as a credit manager, we need to look at that risk as the main risk in credit. And when you look at what's been happening in the loan market and borrowers in the loan market, they're still well placed to service their debt. Interest cover ratios have come down, but they're starting to tick up again. So what you've seen in terms of defaults have come up from the lowest point we've seen in a very long time to back around their historical averages. And now we're seeing interest covers ratio coming up. So yes, you're gonna have some defaults. You're gonna have companies that are gonna struggle to pay or service their debt, but we're not seeing a huge spike in default. And one of the reasons is because there are no walls or imminent walls of maturity in the loan market. They've all been pushed out. So two of the reasons why loans default is company cannot service its debt, or it has to refinance and it can't refinance. Well, those two risks are quite manageable at the moment. So that's one thing. So probably higher defaults, but not a huge spike in the loan world. Now you go to the CLO world. Historically, CLOs, the loans they've held in their pool of assets, have had less defaults than the broader market. So the active management on average has been positive in terms of experiencing less defaults in those pools of assets. So that's reason number one. So even if there's a spike in defaults, then the debt tranches of those CLOs, the risk of a default is quite de minimis. The other consideration is when you think about the way they're structured, you will need to see about 10% or over 10% of defaults in the pools of loans over multiple years to start to see defaults in a triple B CLO tranche. On average, as I said, the loan market has had defaults of about 2 to 3% per annum over the last 15 years. So we feel it's not impossible, but the probability is quite low.
Okay, so if I'm thinking of this as the reader or the viewer, how do you actually create value for the end investor by investing in CLOs?
Yeah, that's a good question. So we love or we really like using CLOs to provide in our portfolios, in our diversified portfolios, credit enhancement because you can buy investment grade credit tranches and yield premium. If you look at triple B CLOs and compare them to corporate bonds of the same rating, you have a significant yield pickup at the moment. I think it's about 4.5%, 450 basis points current yield pickup. So that's quite attractive. So what it means is that if you look at an investor could go and buy 50% of its investment into the loan market and 50% in the high yield bond market and get about 8% current yield. That's roughly what they would get if they did that. But most of those instruments that they're buying are going to be sub-investment grade. And there's going to be quite a bit of duration risk coming from the high yield part because it's fixed rate. If you use CLOs, well, you can build a portfolio where you've got a higher exposure to investment grade credit, where you don't have to invest in the lower quality part of the credit market, so you probably don't have triple Cs, and you still are able to generate an 8% current yield. So same current yield, lower credit risk, lower potential volatility is how we think about it.
All right, Teiki, this has been really interesting. Thank you very much for joining us and explaining it to us as well. And thank you for joining us for The Pitch. If you enjoyed that episode of the show, you can subscribe to our YouTube channel and also to the Livewire and Market Index websites. Thanks for watching.